Hey everyone, I'm Jeremy Szafron. You're watching Kitco News. If you haven't already, don't forget to hit that subscribe button. Well, in today's 2024 economy, we face many complex issues like slow economic growth, stubbornly high inflation, and rising geopolitical tensions. JP Morgan CEO Jamie Dimon described the current geopolitical situation as, quote, probably the most dangerous and complicated time since World War II. This according to his comments at the Economic Club of New York this week. As the central banks, including the U.S. Federal Reserve, navigate these choppy waters, decisions like delaying interest rate cuts have worldwide impacts, influencing everything from your national debt crises that we see ongoing to issues in your wallet. Now, today we're talking with Tavi Costa, a noted macro strategist with Crescat Capital, about these pressing issues. He sees a seismic shift underway in a global financial world, forecasting a major turn towards hard assets like gold as we continue to see growing sovereign debts and economic uncertainty. Tavi, great to have you back. Thanks for joining us today.
Thanks for having me. Looking forward to this.
Yeah, me too. I mean, we got plenty to discuss. I'm going to try and get through it as quickly as I can. We'll start with about 5 months ago, you were on our show. You were actually talking to my colleague, Michelle McCory, about a potential hard landing for the economy in 2024. Well, with recent developments showing the Federal Reserve's delaying rate cuts due to persistent inflation, as we continue to see, how do you assess the potential impact now? Has your outlook for a hard landing changed?
No, I actually, I think it's strengthened the case, really, what we're seeing. We've had a series of rate hikes recently by the Fed, despite the fact that monetary base is still increasing. I think what's been sort of hiding the bearish thesis has been the amount of fiscal stimulus we've had so far. Now, what I think it changes over the next 12 to 24 months or so is the fact that, number one, credit spreads are completely suppressed right now. So basically, we're living in a world where people are starting to at least agree that interest rates are going to be higher for longer, or at least these levels of interest rates that we're seeing in the long end, short end, and so forth. But we're not seeing that repricing happening in terms to risk. So either we're going to go back to this inflationary era, which I don't believe at all, or risk needs to be, or is perceived too low and is completely mispriced. So if you look at things like credit spreads, which is basically measuring the difference between risk-free rates and also corporate bond yields and so forth, you can see that those spreads are very low today, one of the lowest levels since 1995 in one of the charts that I had recently. And that measurement alone it actually happens every time you see the suppression of those spreads during periods of Fed hiking cycle. Now we're kind of at the end of that situation. We went from people expecting 7 rate cuts recently to now less than 2 for the next 12 months or so. And I think people are underestimating the risk of a recession. And lastly, I would point out what's happening with the yield curve. The yield curve is starting to steepen significantly, what we're seeing now, and that usually coincides with the recession too. So if anything, I think things have really straightened up the case for a hard landing, and having the sentiment shift so drastically, speaking across most market participants, I would say that that's more of a worry and not something I would be really supporting my bullish thesis on.
Right. Okay. Well, I mean, the IMF recently said that the U.S. is to grow at double the rate of G7 peers this year. I think their exact quote is, strong household spending investment will help propel U.S. growth to 2.7 this year. That, according to the fund's latest economic outlook. I'm curious, so, when we start looking at this narrative and this data, are they wrong here? Are we looking at the wrong data sets?
I think there's two different things. There's growth in the economy and growth in equity markets. I was referring to a hard landing that ultimately drives multiples to be compressed, and ultimately will cause the economic contraction. One thing the IMF is also talking about that I think it's even potentially more relevant has to do with the sort of fiscal dilemma that the U.S. is facing. And they've been calling it sort of a dangerous path, fiscally speaking, in the U.S., where we're seeing more and more fiscal stimulus at a time when unemployment rates are so low. We're seeing an economy that is growing somewhat normal, and there's no reason to see this level of spending outside of the political reasons of elections coming and so forth. And
Right.
the implications of this is having on the inflation front. I mean, we're basically feeding a structural inflationary problem. There's many inflationary structural pillars, in my opinion, but one of the main ones is reckless fiscal spending. Outside of the chronic underinvestments in natural resources, what you have in terms of deglobalization occurring, and even the labor markets when people are starting to demand higher wages and salaries, all those are inflationary trends themselves. But then on top of it, you add how much of the reckless fiscal spending we're seeing in the US. It certainly adds to the case of inflation. I think the big opportunity or the big high probability of a scenario here is actually more of a stagflation, where inflation stays sticky and even reaccelerates in some parts of the market. And then on top of it, you also have a deceleration of growth that ultimately drives the Fed, and also drives even a contraction of the economy over time too. So I'm quite concerned about those things. And I think that there is a chronic problem happening as well with the treasury markets. What we're seeing in terms of the movement of central banks and the selling of treasuries recently, which it hasn't been driven by central banks, believe it or not. But that's what really concerns me, is the fact that we're yet to see central banks to start selling treasuries. It's a real problem, and more we're seeing U.S. banks. I mean, if you look at lending, for instance, in the U.S. economy, lending has gone sideways. We're not seeing commercial and industrial loans grow because the banks are actually having to buy what? They're having to buy treasuries. They're lending money to the government. So if you think about, things are structurally in a very different environment. Treasuries are in a chronic problem, in my view, and that ultimately will drive cost of capital higher and has to re-rate the valuation of companies at some point.
Yeah, absolutely. I mean, the equity markets must catch up at some point, you'd think. Before we unpack that, because we have a lot to get to, the U.S. national debt is approaching $35 trillion. And the Congressional Budget Office saying that the U.S. budget deficit is on track to soar to $2.6 trillion by 2034. Now, you've pointed out alarming levels of U.S. debt before, which continue to climb. What are the potential consequences here, Tavi, for both the U.S. and the global financial stability here with these debt levels?
Well, it's the role of monetary authorities is the big issue, because what's the capability of them doing anything about inflation when you have the cost of debt being where it is? I mean, just to give you a stats, if the Fed was to cut interest rates by 150 basis points, it would cause a reduction of the cost of debt by the end of the year by about 33%, or 1/3. That's insane. So that means that at some point, the debt problem is going to be so large in terms of the way of we're servicing the debt, that it's going to cause the Fed to become almost irrelevant, because they can't raise rates. They can't use interest rates as a mechanism to fight inflation. That's what is very interesting for hard assets, because the suppression of rates in an inflationary environment that is also fundamentally inflationary for many reasons, like I pointed out recently, it is likely to drive hard assets much higher. And we saw this in the past. 1910s was an inflationary era. Hard assets outperformed financial assets. 1940s was the same. 1970s were the same. And by the way, those decades are very different than what we're facing today. I don't think we ever face what I call a trifecta of macro imbalances, when you have a debt problem like we have, when you have inflation, and also on top of it, you also have valuations being so extreme across most financial assets. So what gives? I think it's a rotation out of financial assets that are so expensive into hard assets. And so to me, there's going to be a lot of opportunities. And it's almost like we're living in an environment where parts of the market are starting to figure that out and other parts aren't. If you look at gold rising when real rates are rising, that seems unthinkable for a lot of people. Now, why is gold rising while real rates are also rising? Well, that's because we're in a different macro regime, and people are starting to price that in, that we're definitely seeing more inflationary problems. And in an inflationary era, those correlations change. Why are we seeing the Japanese yen trade the way it has been trading so poorly? Well, because their economy is facing their own dilemma, where they are seeing inflation expectations rise, and they can't raise interest rates as much as inflation expectations have been rising. So they're being forced in a somewhat of a financially repressed environment that is giving the cost or actually causing the decline of their own fiat currency. And so that's a global phenomenon. And so to me, what is not living in an inflationary era yet? Technology companies. There's some other parts of the markets that are still living like we were back in 10 years ago in a disinflationary era where interest rates continue to go lower and lower. But this is not really what we're living today. Inflation is likely higher for longer, and that is yet to impact a lot of assets moving forward.
Tavi, let's talk about that macro theme that you were talking about. In your latest report, you mentioned that the debasement of fiat currencies is a significant emerging macro theme, particularly noting that this could lead to a pronounced cycle in hard assets. And as you just mentioned, buying the gold, of course. Elaborate on what you see happening with fiat currencies, especially the US dollar in the coming years. And, which hard assets do you believe that these are going to be unleashed in this environment?
Lots of them, and mostly commodities. Hard assets can be breaking down. Even the housing market participates as a hard asset. But the most asymmetry you can find is likely to be in the commodity space, and not even gold. I mean, gold is likely to drive things higher and like to be the sort of the leading of the pack. But what really leads from a price perspective is going to be the other things that are so cheap, such as silver, the miners, platinum, copper, and other things that are still historically cheap relative to gold itself. Now, what is important here is that what I mentioned in that whole report was a concept that I've been thinking a lot about. We know that we're living in a more deglobalized environment than we were back 5 years ago, but more from a logistics perspective, more from a reshoring perspective. We're seeing countries, having to improve their manufacturing capabilities. We're seeing defense spending. We're seeing conflicts we haven't seen in many years. There is also a deglobalization era also being unleashed from a financial standpoint too. And that I mean through what central banks hold in terms of their balance sheets and assets, in terms of the need for owning a neutral asset like we haven't seen in many decades, such as gold, and a neutral asset that has centuries of history in terms of being a credible monetary asset, different than Bitcoin in this case. Not to say that Bitcoin will likely also benefit from these trends, but gold is the only one that carries that profile. And so we're seeing a large purchases or accumulation of the metal. That doesn't come as a surprise. The more important question is this a sticky movement? Are we going to see even more of that accumulation moving forward? Or this is all that we've seen so far is actually what we're going to get? And my answer to that is look at throughout history. And what you're going to find is that central banks back in the days used to hold close to 75% of their assets in gold. And now we've been through a 30-year period where we've seen them accumulating treasuries and other sovereign debt instruments rather than the metal itself. And now we're at the beginning of this trend reversing. And I think there's a long ways to go. And as we see gold actually breaking out and continue to break out moving forward, and I think we're going to see stupid levels in terms of gold prices by the end of this decade and so forth. We're yet to see that actually drive other assets that are usually have leverage to gold prices. And that's why I get so, I think there's such an opportunity to invest in the mining industry because it's been forgotten. And I find it hard to believe we're going to see all these things unleashing without making that industry at least more relevant of what it is currently.
Yeah, absolutely. I mean, this week we observed some interesting moves in gold prices. We had a pretty significant drop followed by prices somewhat stabilizing above the $2,300 mark. I think that's kind of where we're sitting at now. Explain what might be driving these shifts and how should investors interpret these movements here?
Well, the short term, I'm just as good as anybody else in analyzing the short term movements, and I'll try to explain and give some more context on that. Look, I think despite the movement we're seeing in gold prices, mostly driven by central banks, and why we're seeing this movement, I sort of explained already, but how do we know it's central banks? So we know that because we're not seeing the inflows caused in other vehicles like the GLD, which is an ETF, most liquid ETF in the US, that retail investors tend to buy. We know 60-40 portfolios are named 60-40s for a reason, where investors continue to completely neglect gold and buy treasuries. And you look at even the TLT ETF as a good proxy for fixed income, which continues to see more and more inflows despite the prices of the asset being completely vanished in the last 2 to 3 years. Now, what is important here in this sense is that central banks don't usually buy the miners. And so you're seeing this lagging effect where gold prices have been rising and the miners are still lagging here. That to me is the real opportunity. Silver prices are starting to move. Copper prices are starting to move as well. Copper should be, I think, following the same path of gold itself. If you look at, you can also, if you want to find a roadmap, look at those hard assets relative to Japanese yen, because I think the Japanese economy is a good proxy for the US in terms of the amount of leverage and how we're likely to see this global debasement of fiat currencies. And so as we see that unfolding, we're likely to see much higher prices in metals, and that ultimately also drives the miners. And so, to me, it's sort of kind of shocking to see how the sentiment is so bearish towards this industry when we're probably approaching, I think, a historical bottom. And it doesn't resemble the early 2000s, because the early 2000s wasn't as much of a bottom and sentiment-wise as it was, for instance, back in the 70s. With this industry. And I think we're kind of in a similar environment where the mining space is probably the most hated part or segment of the market that I can think of. And it usually that level of skepticism at some point morphs into opportunity. So I'm really glad to be part of this right now, because I really think that that's where the opportunity will be ahead. And the other thing I was going to point out is that for investors, it's really hard in general to allocate capital on things that are cheap, because the whole buying low and selling high mentality is a very different concept to actually practically do, because there's reasons why things are selling at such low levels. Now, I think the most conventional thought about the miners, for instance, is to say that they don't make any money. And I've heard this so many times in my career already, but things change. And usually when things have such a poor sentiment, as much as we've seen in the mining industry, you tend to see some things that are starting to shift from an upside in terms of the fundamental improvement in this overall space. And I think we're starting to see some of those, and ultimately it drives capital into the space again. And the last thing I was going to say is, there's something usually investors lack, which is you can borrow someone's macro thesis about some things. For instance, I often talk about gold, and I offer a bunch of charts and all that for free, and all these ideas for free. Now, nobody can borrow my conviction on this. And conviction is such an important aspect of investing, because when you have prices of gold, for instance, you just mentioned that volatility in gold prices. I love that, because I know my conviction, and I can confidently come in and deploy more capital on things that I think are cheap because of the conviction in my thesis. And most people that borrow someone's thesis don't understand that they don't have that same level of conviction. And that's a big difference in allocating capital over time.
Okay, so Tavi, historically markets have sometimes thrived even under significant geopolitical stress. We talk about what's happening in the Middle East. We talk about what's happening between Russia and Ukraine. So I'm curious, could the current global tensions potentially open up some opportunities for investors to capitalize on, maybe in different asset sectors than the hard assets, maybe in certain sectors here?
Yeah, that's a good question. I think separately, there's one maybe a little bit less correlated to hard assets that I would point out would be the biotechnology industry, in which this AI revolution can certainly drive a lot of innovation, and probably it is not priced for perfection like most of the technology companies. And I would say that offers some opportunity for most investors that are actually doing their homework. I would say more separately from that, and maybe a little bit linked to the hard assets idea, but it's also something that hasn't really been performing well over the years that I think will actually be a great opportunity, will be emerging markets. Emerging markets, I would break down mostly through this natural resource lenses. I think those that have very rich commodity exposure will be the ones that are going to benefit from this environment. I think I've said this to you before, but I see the development of countries in three ways. The ones that really succeed is either through technological advancement, or you can see this through demographics. India is a great example. And the third one is through natural resources when you enter a commodity cycle. And I think commodity-rich economies offer a great opportunity for the following years. I'll use I call this the AI, artificial intelligence paradox that we're seeing, which has to do with the labor markets. One of the main reasons why emerging markets have been underperforming and also have such a discount from valuations relative to developed markets has to do with the quality of the labor markets. When you think about the U.S. itself, it attracts most of the high quality labor market you can see in the world. You can have students coming in to learn about and go to college and actually come work for major companies and so forth. And it creates this true melting pot that we don't see anywhere else in the world. I'm from Brazil. I don't see Americans coming to Brazil to actually, that want to go to colleges in Brazil and actually work for Brazilian companies. Right. And the shift that I think we're going to see is that AI as a enabler of capabilities as a tool is likely to equalize the quality of labor markets. I'm not saying we're going to see people, go into Brazil or anything like that, an influx of immigrants, so forth. But I think what we're going to see is an equalizer of a quality of labor markets and making those businesses more efficient over time. So despite the link with commodities that I think is very obvious, there's also another take on this, and where artificial intelligence may actually help quite a lot the smaller companies, and from a global perspective, is smaller economies, which usually are emerging markets. And so I would think that Brazil is actually poised to do very well. South America as an overall region is likely to do very well. And there's going to be other opportunities as well. But those are the ones that I'm very focused on right now.
Yeah, no, it's so fascinating to think of the world with AI. I mean, just thinking about Brazil itself, as we sit here, 50% of the world's population this year is going towards elections. Is there anything we should be looking at from looking at those emerging markets? Is there any, not black stained markets, but anything we should be kind of cautious about looking towards, I guess, regulations?
I think, there's always that risk. It's always the risk of the jurisdiction risk is always going to be there. And investors, there's a price for anything, for any asset, right? So you just really want to be looking at what is that price today relative to history. When you start thinking about the historical opportunity in terms of how cheap those assets are, how undervalued they are relative to other periods, that's what kind of builds the case of why prices are so attractive. Now, Brazil is never, it's been an emerging market for decades, right? People have been calling an emerging market for many decades and never emerged to be a developed economy. Right. And I'm not here to claim Brazil will be a developed economy. And I think by the time when we start seeing the markets, people say that Brazil will be the next, developed market and so forth, I'm probably going to be out of my investment, because that's the time when people already agree with you. And investing is all about people agreeing with you in the future. And so to me, that's an important aspect. And so I think that Brazil offers great opportunities, but the political risk will continue to be there. The political leadership is something that people need to be aware of. What we're seeing with the Lula leadership is scary and negative, I think. And I'm actually saying this from an investment perspective, not even my own political views, which happen to be similar, but in this case. But I do think that this carries bigger risk than people believe. Now, the opportunity itself is larger because the Brazilian politics, if you think about from a leadership perspective, it has never been so, disintegrated in terms of the political power. We haven't had a right-wing party in many decades in Brazil. This is the first time we're seeing polarization in politics. I can speak for that from my own family and also friends, but also you can see this even from the political leadership itself. You can see some issues in terms of conflicts of ideas, and that is positive. That's one thing the U.S. has always had for many decades compared to other places, that I think it's a very positive thing. The polarization, believe it or not, is actually more positive than negative. Although it causes protests and other issues, at least it's an exchange of ideas rather than one idea. I think the South America has suffered from that for a long time. Usually you have, a communist party and a left party. That's the level of polarization we've actually had in South America for many decades. Just now, we're seeing other parties that offer very different ideologies, and which I think it's extremely positive for the overall region.
Yeah, it's positive. It's going to be fascinating to watch what happens with this ex-Elon Musk fighting in Supreme Court about, the fact of we're free to say what we'd like to say as well, Tavi.
Well, here's another one, right? Well, not because of that, but we've had a pullback in Brazilian equities,
Right.
and recently, 15, 20%, depending on the asset. Now, you can borrow my thesis and say Brazilian equities look really cheap. Now, do you have the guts to go there and buy when there is a 20, 15% pullback? Now, I'm not saying here that this is going to be it, that we're not going to go lower from here. Now, I do think things are cheap. So me, as a person who's got conviction in this thesis, I will step in and deploy capital into that. So I think this is time to be deploying capital and things like that. So, I'm just trying to explain more in a practical way how an investor that actually has conviction on an idea, it tends to act when you have those types of dislocations in markets, which are normal. Those are normal things. Now, what we're seeing with gold volatility, that's normal. Things are not going to go up on a straight line. Do you know how much miners actually declined during the 70s at some point? There were moments in miners went down 70% during that period in the 70s. But the overall decade, it was a very profitable decade. So imagine, being caught up in some of those situations. It's just part of the game. And you have to have that level of conviction to endure in this market. Otherwise, you're just going to get killed.
Could lead to profits too. Buy the dip, as they say. Tavi Costa from Crescat Capital joining us today. Hey, thanks, my friend, for coming on. I could have talked to you all day about this stuff.
Thanks for having me. Appreciate the interview again.
Of course, we'll see you next time. I'm Jeremy Szafron. Thank you for tuning into Kitco News. Don't forget to subscribe and to like that video, and we'll see you next show.